Welcome back to Investing Talk podcast. Today we're focusing on the company Nucleus. You've shared some interesting material with us, basically a look at their recent financials, some business analysis, and what's been happening with them in the market. Our goal here is simple. Unpack all of that for you. Pull out the key insights, those aha moments, so you can get a really clear picture fast of what's going on with Nucleus based just on this material.
And this snapshot, it covers their numbers, their strategy, recent market moves. It gives us a very specific viewpoint based on the information you gathered.
Okay. Now, before we really get into it, if you find value in these discussions, if they help you cut through all the noise, please take a second to subscribe right now. Like this content, maybe leave a comment below with your thoughts or even question. And if you're feeling generous, buying us a coffee genuinely helps us keep producing these detailed breakdowns for you. We really appreciate the support. All right, let's open this up. Nucleus. Based on the material. Wow. The first thing that really hits you is the revenue situation. I mean, the information shows a pretty dramatic decline just over a couple of years. We're talking revenue falling from what? $21.3 million in 2022, down hard to $5.9 million by 2024. And then Q1 2025, the most recent quarter in the report, it shows zero revenue, nothing. Then their core financial services and general support areas, well, that's not just a dip, is it? That's like the bottom falling out of their traditional business.
It is quite stark. What's particularly notable is how this material lays out a very clear negative growth trend over those 3 years. And that zero revenue figure for Q1 2025, what were their main segments? That's significant. It strongly suggests that, at least for that period, the sources cover the core operations. They just weren't bringing in any sales at all.
Right. And when you see that kind of revenue picture, you'd naturally expect, well, losses, right, a rough bottom line. But the material then throws this curveball. It mentions profitability in Q1 2025, a net income reported at $102.96 million compared to a loss the previous year. I mean, on the surface, that sounds incredible. How does that happen with zero revenue in core areas?
That is the crucial question. And it's really where you need to look closely at the details provided in the financials. The sources clarify this. That huge profit, it's overwhelmingly driven by a non-cash gain. Specifically, about $104 million of it comes from changes in the fair value of stock purchase warrant liabilities.
Okay, hold on. Non-cash gain, fair value, stock purchase warrant liabilities. That's pretty technical. Can you break that down a bit? What does that mean for their profit?
I can try. So think of these warrants not as shares, but more like options or promises linked to the company's stock that the company itself issued. Now, the value of these promises, these liabilities on the company's books, it can change based on market factors, the stock price, things like that. Accounting rules say when the value of a liability decreases, the company has to record that decrease as a gain.
Ah, okay. So it's like a debt shrinking on paper, making the balance sheet look better, but no actual cash came in from selling things.
That's a good way to think about it. This $104 million gain isn't money from customers. It's not from operations. It's purely an accounting adjustment reflecting a change in the estimated value of these financial instruments.
Got it. So that headline profit number, the $100 million plus, it's not from business operations at all. It's an accounting artifact. And that, as the sources suggest, completely changes how you should look at metrics like EPS, earnings per share, right? It's not operational success.
Precisely. It's critical context that the material provides. Without it, you might get a very misleading impression of the company's performance. With it, you understand the profit source is entirely separate from their historical business activities or any new sales generation.
Okay. Moving beyond those headline profit numbers, the material also touches on other financial health indicators. Debt, cash. It notes interest expenses went up, $164,000 versus zero the year before. That points to more borrowing or maybe higher interest rates. And maybe more importantly, the sources flag a working capital deficit, around $56 million as of the end of March 2025. The material calls this out as a clear sign of balance sheet stress. What does that mean practically?
That working capital deficit is definitely highlighted as a major point of concern in the material. Put simply, working capital is the difference between short-term assets, things like cash, receivables, and short-term liabilities, meaning debts due within a year. A deficit, like the $56 million mentioned, means their immediate obligations are greater than their liquid resources. That can make it tough to pay day-to-day bills, suppliers, payroll, without needing more funding.
And on top of that stress, their cash pile also went down from $6.9 million at the end of last year to about $4.5 million by March.
So when you combine these points from the sources, the higher interest costs indicating more leverage, that significant working capital deficit, And the shrinking cash reserves, the picture that emerges is one of, well, financial fragility, significant pressure on the balance sheet. The decreasing cash suggests they might be burning through funds, or at least not generating enough cash from recent activities to cover needs.
And the material doesn't just leave these numbers hanging. It actually compares Nucleus to what it calls typical sector peers. How does that comparison look?
That comparison is quite revealing, according to the sources. It contrasts Nucleus with what are described as typical peers companies, often showing, stable or growing revenues, consistent earnings from their actual business, meaningful PE ratios based on those earnings, manageable debt levels, positive cash flow. Against that backdrop, Nucleus, based on this assessment, looks very different. Sharp revenue decline in the old businesses, earnings driven by non-operational accounting, indicators of balance sheet stress like that deficit, weak cash flow. It positions the company, according to this material, quite differently from more established players.
So, with all these financial challenges in its traditional space, what exactly is Nucleus, or what was it doing? The material describes its history mainly in fintech, right? General support services, financial services, software, fiat to crypto stuff.
That's the historical description. But what's really fascinating, and probably the single most important strategic point in the material, is the massive pivot it highlights. The sources clearly state Nucleus is moving away from those legacy businesses.
Moving away completely. Where are they going?
Towards the defense sector, acquiring defense-related assets.
Wow. Okay.
The fundamental strategic shift, which means, importantly, those revenue figures we were just discussing, the zero. That's from the businesses they're apparently trying to leave behind. Their future, according to the strategy outlined in these sources, is supposed to be in a totally different industry.
That is quite a turn. Does the material give any sense of their competitive footing, either in fintech before or now in defense?
Well, regarding competitive advantages, the material notes there isn't much clear evidence presented. Things like patents, strong brand recognition, they aren't highlighted. In its old markets, the material kind of positions Nucleus as more of a, let's say, sector laggard or challenger, not a dominant player. As for defense, that's a whole new game. The material mentions the shift towards acquiring assets there, but doesn't really detail their specific competitive position within that new field yet.
Okay, this pivot to defense. What does the material say about the industry factors or risks tied to that specific move?
It's definitely presented as a high-stakes gamble. The sources do acknowledge that the defense sector could offer growth potential, especially with global spending trends being what they are. But, and this is a big but, it immediately exposes Nucleus to a whole new world of risks, particularly heightened regulatory scrutiny. Defense is a heavily regulated industry, very different from fintech, so that adds significant operational complexity and compliance risk.
Understood. So, shifting to how the market is viewing all this, valuation, risks, recent news, what does the material cover there? It mentions price to book is probably low because of that working capital deficit we talked about, no dividends, and it suggests high volatility, even if a specific beta wasn't available.
And the risks section in the sources really emphasizes some key points. That $56 million working capital deficit is flagged repeatedly as a major concern. Also, the reliance on those non-operational accounting gains for profit, that's highlighted as a risk because it masks the underlying business performance or lack thereof. Increased borrowing costs are noted too.
And risks tied specifically to this new direction, the pivot.
Yes, the uncertainty around whether this big strategic shift into defense will actually succeed, that's listed as a major risk itself. It's tough breaking into a complex new sector. The sources also bring up potential dilution risk from warrants or other adjustments, possibly increasing the share count down the line. And there's a specific near-term risk mentioned too, related to asset deals or loans involving a company called Star 26 Capital. The material indicates this increases risk if certain conditions aren't met by the end of November. That's a concrete date mentioned.
Sounds like a lot of potential hurdles outlined there. What's actually been happening recently? Any specific news or events the sources mentioned?
A couple of things. Nucleus participated in the Microcap Rodeo Conference back on June 4th. That's usually about getting in front of investors, boosting visibility. But the material also points out that in the immediate period leading up to the report, things were quiet. Specifically, the last week covered. No major press releases, no new earnings updates beyond that Q1 data, no big management shuffles announced. Relatively little news flow, according to this information.
Okay, so you have this complex picture. Financial stress, a huge pivot, identified risks, then a bit of a quiet period on the news front. How has the stock price reacted to all this, based on the material?
The sources report noticeable volatility, and specifically some recent weakness in the stock price. Looking at the data provided, there was a drop of just over 5% on one day, June 12th, closing at $12.12. And leading up to that day, over the previous 10 days, the stock was already down almost 14%. Interestingly, the material also notes that trading volume actually decreased during this recent price slide.
Lower volume on the way down. What does that usually suggest?
Well, according to the analysis here, it can suggest that while there's selling pressure, it might not be driven by, say, widespread panic or conviction selling.
Yeah.
It could imply fewer buyers are stepping up at these levels, causing the price to drift lower on lighter activity rather than a huge rush for the exits triggered by some specific bad news.
Does the material offer any kind of forward look, any forecasts for the stock price?
It does mention a short-term outlook cited from some forecasts. And despite the recent drop, these forecasts apparently suggest a potential rebound, something like 5.5% over the next 3 months. They even give a probability range for where the price might be by September 2025, though it's quite wide, somewhere between roughly $12.79 and $23.18.
A wide range indeed. What about the bigger picture? Market context, investor sentiment. Does the material touch on that?
It notes that even with the pivot, their historical association with areas like digital assets means they're still somewhat exposed to broader sector trends there, like regulatory uncertainty, which continues to be a factor. The sources didn't find any major recent actions by competitors that directly impacted Nucleus, but general sector volatility is always there. As for sentiment specifically about Nucleus, the material suggests it's somewhat limited, but what's visible seems to be a mix. Cautious optimism, perhaps about the potential of the defense pivot, but mixed with clear warnings about those short-term downside risks, especially the financial health issues. So, pulling it all together then. The financials, the strategy shift, the risks, the market action. Why the recent stock weakness, according to this material? What's the main driver?
Based on the analysis provided here, it doesn't seem to pinpoint one single recent piece of bad news as the sole cause. Instead, the weakness appears more influenced by, well, the overall picture we've discussed. General market sentiment playing a role, combined with the underlying financial stress that's evident, the significant uncertainty surrounding this major strategic pivot, and importantly, a lack of fresh, positive news or catalysts coming directly from the company recently. That declining volume we mentioned might also suggest investors are kind of waiting on the sidelines for more clarity before making big moves.
Okay, so let's boil it down. What does this all mean for you, the listener, trying to get quickly informed based on the material provided?
I think it paints a picture of Nucleus as a company in deep transition, facing clear financial difficulties in its traditional lines of business, where the reported profit is really an accounting outcome, not an operational one. You see signs of significant balance sheet pressure, like that working capital deficit. And overlaying all that is this massive, and the sources imply, uncertain strategic bet on moving into the defense sector.
Right. The material really highlights a company undergoing huge changes, where the past performance doesn't reflect the future strategy, and where the current financial state presents very real hurdles that this new strategy somehow needs to overcome.
Which brings us to a final thought, really a question for you to consider based on all this. Given the scale of these financial challenges outlined in the material, the disappearing legacy revenue, the balance sheet issues, the reliance on accounting gains, can a strategic pivot into a totally new field like defense realistically generate enough success fast enough to overcome those fundamental problems? Or do these structural financial issues represent a deeper, more fundamental challenge for the company, almost regardless of the new direction they're taking?
That's a very poignant question to end on. A lot to weigh there. Thanks for walking us through that intricate situation based on the material.